So a bit of a week in review. I think the thing to start off with is obviously the Beige Book in the United States, after we also had the testimony from Fed Chairman Powell. And I think the interesting aspect, particularly in the context of Donald Trump's commentary yesterday, that he was not exactly happy with the stronger dollar or the prospect of higher rates, is just how much of those Beige Book comments highlighted that the US is basically not only growing strongly, but also seeing a lot of capacity constraints emerging above all in the labor market, that there are upward pressures on prices, primarily in the industrial sector and in the producer sector rather than the consumer sector. But it really does point to a solid reasoning and a solid rationale for why the Fed should continue to hike rates and why at the same time, obviously, we have a strong dollar. The corollary of that, obviously, is that there's been an enormous amount of discussion about the weakness of the yuan. And on the next slide, what I've done is just basically try and highlight a very simple point. Everyone's talking about the yuan weakness, but no one's actually acknowledging the fact that the new target or the new index which the Chinese authorities target in terms of FX is very heavily weighted towards Asia. So what happens if we compare what's been going on with the yuan as against the Korean won and the Japanese yen, the other two major currencies in Asia, and we actually see that it's been exactly the same pattern pretty much ever since the beginning of June. So talking about yuan weakness on its own seems to miss the point that this is actually not some form of devaluation effort, but rather that the Chinese are merely being obliged to let the yuan weaken a bit because of the weakness in the rest of the Asian currencies. Now, in terms of Korea and Japan, that's not quite so bad, but for some of the other Asian currencies, the hurdles which they're going to face as we go forward are going to be more substantial. So let's have a look at the next slide, which is the JP Morgan Emerging Market FX Index, which one can see has broadly started to stabilize a little bit, but there is still quite a lot of weakness there. We are basically retesting the lows that we saw in 2016. And that highlights the point that we've actually been, with the dollar rising, we are going to see a lot of problems in terms of the emerging markets area, particularly the, shall we say, the smaller economies, small to medium-sized economies, some of them tigers, in terms of the refinancing. And in that respect, it's worth just recapping just how much has been borrowed by emerging market sovereigns over the past, and indeed corporates, over the past years since the global financial crisis, which we can have a look at on the next chart, which highlights that we've basically doubled the volume of outstanding volume of emerging market foreign currency debt. And most of that will be in dollars, and therefore every time the dollar goes up a little bit further against those currencies, the higher the refinancing wall becomes. And that brings us to the final slide that I've got here today, which is the refinancing wall that they face over the next couple of years. It was fairly low last year, but this year it rises to about 140 billion, 150 billion, and then continues to at that pace or slightly higher in coming years. And with the dollar that much stronger and expected to remain strong as long as the Federal Reserve is effectively raising rates on its own, this is going to prove to be rather more troublesome. And this is basically the real weakness in terms of, or the real risk in terms of the global economy, that one or other of those emerging market economies doesn't continue to grow as well as it should, and then faces some sort of refinancing risk. We've highlighted Turkey before, but particularly those countries which are seeing their currencies fall quite sharply, like Indonesia, they're going to be countries which are also vulnerable. So this is still the space in which there's the most contagion risk for other asset classes, which one must say, outside of the commodities and FX space, continue to be very well behaved, continue to be very well supported by the extant volume of quantitative easing from the major central banks, and indeed, obviously, by the continued QE from the ECB till the end of the year, and beyond that, obviously, the Bank of Japan. So that's where the constellation of risks lie at this moment in time.